Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod, where we amplify voices from across the agricultural industry. We aggregate those perspectives, and we do this to elevate our collective thinking around strategy execution. I'm your host, Joe Mosier. Now, today it is my pleasure to welcome Shane Thomas back to the show. Shane is the author of the weekly newsletter Upstream Ag, where he aggregates, analyzes, and synthesizes essential news for agribusiness leaders, namely, though not exclusively, in the areas of agronomy, crop fertility and protection, ag retail, and ag tech. Now, for longtime listeners, you'll recall that Shane has been on the show twice before. In those episodes, we discussed the concepts of strategy tax and innovation theater. We're both big fans of frameworks to help shape our thinking and help think about opportunities and challenges in the industry. And I'm going to be sure to link to those episodes in the show notes. Today, we're going to continue that tradition. We're going to dig deep into an article Shane published in November of last year titled "The Four Forces Reshaping the Crop Protection Industry." Our conversation is going to go deep into these topics and how the structural shifts that Shane is highlighting are rewriting the future of crop protection and what the implications and opportunities may be for downstream players at the independent ag retail and cooperative level. Now, a quick reminder to like and subscribe to the show wherever you get your podcasts so you never miss an episode. You can do that right now on your podcast platform of choice. And if you're so inclined, please consider leaving us a review at the end of today's show and letting us know how we're doing. Thank you, as always, for joining us today. And with that, here's my conversation with Shane Thomas of Upstream Ag. Shane, last year, and I think it was in November 2025, in one of the editions of your Upstream Ag newsletter, you had an article that was really talking about a dramatic shift in crop protection and kind of the downstream effects I see for ag retail. You wrote in that newsletter, and I quote here, "The global synthetic crop protection industry has been changing for years. While the question has been whether it is structural or cyclical, the structural changes are hard to ignore. The traditional model has been anchored in discovery, patented products, and broad distribution influence and control, but that is being eroded from multiple sides." End quote. What does this multifaceted erosion in that traditional crop protection business look like? And why do people need to be paying attention?
Yeah, I think it's a great question, Joe. I think there's a few things to look at here in the sense that I've been listening to a bunch of different executive earnings calls and presentations and all that. And there was always this talk about how the Corteva or Bayer or FMC, the major crop protection companies, saying this is cyclical. This is going back 2022 when there's still challenges, destocking, all these different things. And there was a lot of talk about how there were not structural changes. It was just cyclical. And I started to think about some of the different things I'd written, and maybe quickly just to differentiate between cyclical and structural. I think cyclical is just something that is like a mood swing. It's like the commodity prices, you have to get through this quick downturn. But structural are actual transformations where technology, regulation, or societal values actually change the dynamics of how somebody does something or demand of something. And so to bring that back to what the executives were talking about is that they were always saying, hey, you know what? There is a ton of demand. And I don't think that's wrong. There is continued structural underlying demand for specific outcomes from farmers, meaning they want weed-free fields, they want insect-free fields, disease-free fields, etc. But I think while that demand is still intact, there's the how of achieving those outcomes, and the profitability and margins within that demand is shifting for the crop protection companies. And I'd been thinking about all these different pieces that I'd written about randomly or sporadically over the last 4 or 5 years, but I'd never pulled them together into one, call it holistic article, looking at all of them and how they're impacting the underlying industry itself.
And so you called it, I think it was the four forces. And so the four forces are sort of driving, if I understood correctly, that multifaceted erosion. And to kind of build on your structural versus cyclical statement, cyclical also, for me, implies a sort of repeatability. It's a cycle we've seen before. this is a boom time for our products and demand and distribution, capture the opportunity. This is a thin time, survive. It's a boom time, capitalize, thin time, survive. But when we come back to the four forces, maybe walk us through what they are at a high level, and then let's maybe dig into each one of those.
Yeah, sure. So the way I identified it, and I think there's probably a few different ways people could get into it, but to me, the first was the expansion of generic and synthetic crop protection manufacturing around the world and where it was specifically in China and India, and we can come back to that in a second. But number two was the patent cliff and innovation stagnation. So just a continued decrease in new molecules and new active ingredients and new modes of action coming to market. And then there was regulatory dynamics. So whether that's just the actual challenges of getting registration or the anti-competitive scrutiny going on in the US or environmental pressures writ large. And then the fourth, which I think is actually an under talked about segment or area of the industry, is really complement disruption and commoditization. And that's really more the dynamic of the precision ag and equipment. So see and spray technology, for example, that really can shift the locus of differentiation for crop protection products towards that piece of equipment. And so those are really the kind of four I hit on in the article.
All right, well, let's talk about generics. And we hear a lot about generics. We know that there's interest in the comparative price advantage of a generic versus a patent product or a branded product. We know there's a build out of manufacturing and distribution for them. We also know that there's hesitancy among a number of producers around trusting a generic versus trusting a product where you have a return channel for underperforming or excess products that have been purchased. But maybe talk to us about the expansion of generics and how that fits into the framework that you put forth.
Yeah, I think first and foremost, just a lot of these really good molecules, whether it's herbicide, insecticide, fungicide, were discovered in the 90s or early 2000s. So they're off patent, meaning anybody can formulate them and bring them to market. And so that was kind of the one core thing. But within that dynamic, you also had a proliferation of manufacturing capabilities in China and India specifically, but other parts of the world as well too. But I think there's some interesting stats that I found in an article. I believe it's called like the Generics Revolution, the new economic geography of the pesticide industry. So if you want to check it out, very interesting. But it essentially showed that in early 2000s, the export share from China to Europe for crop and North America for crop protection products was something like 15%. By 2023, it had grown to 46%. And then if you look at the actual manufacturing footprint itself that's delivering on that, there's something like 520, 530 different manufacturing plants for active ingredients around the world. And 36% of those are in China and 18% are in India. So you have 54% in those markets, and they've grown rapidly over the last number of years. And I think that's crucial for a couple reasons. One, meaning when you start to put up all these hard assets, your CapEx is growing, you need to produce to be able to spread your fixed costs across these goods. So all of a sudden you have more products being manufactured and there's a home that needs to be found. So all of a sudden there's more of these active ingredients that are being shipped to North America or being shipped to Europe or wherever. There's access, so that decreases the price, which makes things more challenged, of course, for the branded product companies that might still have a unique formulation of the off-patent molecule with a patented product. But I think there's something like in 2000 or so, there was like, I don't know, I think it was around 30% of the products used by farmers, and this is global numbers from, I believe it's S&P Global, I think 30% were generic, and in 2021 or so, it was about 80% were generic. So you had a really big growth coming out of there, of course. And I think that's really one of the big drivers is just you have a bunch of different product needing to find a home in the market. But then that also opens up some interesting doors in the sense that if I'm a North American ag retailer that has any sort of scale or size, I now have the ability to go over to China and bring a product back. Again, there's some nuance to that. You need to still be able to get the registrations. You need to find the right products. You need to have good relationships. But that's kind of the one core thing. And I think maybe one caveat that I do need to highlight is just because there's all these manufacturing plants, I think there's still some nuance in the sense that not every manufacturing plant can manufacture every type of crop protection molecule. So some might focus more on diamides, some might focus more on glufosinate and be really good at that. And there might be more of glyphosate than glufosinate, but writ large and at a generalized level, just a ton of capacity on the crop protection side of things that came online over the last number of years.
And this is a bit maybe not relevant to exactly what the thesis of the article was, but the business case for the significant manufacturing build out in China and India, do you have a sense, was that predicated upon, with all these products coming off patent, we can now produce them, we can domestically produce to meet our own needs and then realize the opportunity to amortize the costs over more volume by becoming exporters? Or was it strategic in saying, let's antagonize the traditional manufacturing hubs because they're not building out for the generics, because it's classic innovator's dilemma, right? It's the next opportunity undermines your existing cash cow. And so who's going to do that? Any sense there on why it occurred in those places?
Yeah, I think you probably nailed it. I wouldn't have a better explanation than that, Joe, of what you just laid out. Both, I think the former specifically driving it. What's maybe interesting that wasn't in the article, because this just came out a week or two ago, but there is some new export taxes that were announced in China on specific molecules, which is, I think it was like a 9% tax, or maybe it was a cutting of a rebate. I can't remember the specifics of it, but essentially it was going to increase the cost of the glufosinate ammonium, so a Liberty molecule, by something like 9 or 10%. But the rebate or the tax was not on something that was actually formulated. So you almost get this now incentive to not just be exporting the raw inert or the raw active ingredient molecule, but potentially formulating stuff in the future. Again, I'm maybe extrapolating a bit there, but it is kind of interesting to see how this plays out. But I think to answer your question directly, Joe, it was really just seeing the opportunity as these molecules were coming off patent.
And so you also cited that statistic there, and these are directional numbers just for the listeners. So take us with a little bit of a swag estimate here, but where had been 30% roughly generic off-patent products being applied globally. At some period in the past, it was now up to 80% in 2021, which is now shockingly already 5 years ago. Is that equally distributed globally? Do we see a higher or lower level of a generic adoption within North America? Kind of what does that look like now for the American and the Canadian producer?
Yeah, so I don't have the specific numbers. My guess is you would see a lot higher numbers in LATAM and Asia, for example, generally. But what's interesting regarding North America specifically is and Canada's probably even lower than the US, although going up now too. But I think fundamentally, COVID drove a lot more interest and openness to these products, because all of a sudden there was the destocking, there were supply chain issues. You couldn't actually secure supply. So now the farmer was, hey, the only thing I can get is a generic. They used it, realized, hey, this actually works just like the other product. That I'm generalizing there. That's not always true, but all of a sudden the openness to using generics, I think, was catalyzed more through COVID, or call it the early 2000s as well.
Yeah. Well, I think this is something that clearly for our co-op listeners and even independent ag retailers, I mean, looking at the generics as an opportunity to pass on some pretty favorable pricing to the grower is there. Now, it does, to your point, it's not, you don't flip a switch. You need to have relationships. You're going to need to be able to aggregate or guarantee a certain amount of volume to become an attractive channel partner for an overseas manufacturer. There's going to be requirements, of course, as well, which further enhances the requirement for volume, because those costs need to be distributed over significant volume. But I've heard anecdotally, and with a couple of clients that have been approached by folks that are creating almost like a domestic consortium to create a regional white label or private label product. And I think folks are looking at it, but I haven't seen the uptake yet. So I'd be interested, maybe something for us to research for the future too, is what is the true domestic traction in the US around some of these generics, and what are the channels by which it's having the most success. I also know, sitting in boardrooms, farmer owner board members are articulating concerns of the membership around efficacy of the product, reliability of the product, what happens if the product doesn't work, because a lot of the headline manufacturing companies certainly have de-risked that from the producer standpoint through some of the different mechanisms they have in place. And so, but it's very interesting.
Yeah, I think you're right on some of the opportunity, and even for the groups that don't have the scale or don't have the desire to go there in terms of actually taking on that sort of white label and more complicated partnership sort of approach. There are now companies that you can talk to that have the relationships there, and they're almost in this kind of call it in between, like a really high end company, meaning like the Bayer, the BASF, and call it below like a true generic provider, where they are actually working with their retail collaborators and they're identifying, hey, can we co-mix different products, bring this in, and now you have a semi-differentiated product. And I can name the names of those, where if you look at FBN just announced that they were spinning out GCS. And so GCS is a company that has registrations, they have relationships into Asia and India, and they can actually bring products in that would do what you alluded to, Joe, where you can actually bring in as a retailer, a product that is going to compete in the low end side of the segment to support customers that are wanting to cut costs while still being able to make some sort of margin on that. And there's another company in Canada that just recently launched called Avesta, and they're doing something similar in that regard. And so there's definitely different opportunities there. And I think what that kind of proliferation has done in terms of the manufacturing has opened up these different doors and opportunities. I don't inherently think generics purely from the retail perspective in this comment, I don't inherently think that means poorer margins, tougher altogether. I think, of course, there is going to be some challenges and some things that need to be figured out, but the right sort of investments, the right sort of partnerships and collaborations can actually still produce positive results that can still make money for a business.
Yeah. Well, and you have Javon's paradox too, that the cheaper resource becomes, the wider the adoption of the application said resource could be. Now, of course, in this context, is going to run straight into the efficiency of application, which we'll talk about later, can also reduce usage of some crop protection products because the efficacy is increased and the application is more targeted. And so, but I think having something that's cheaper, even if you sacrifice a bit of margin, the lower entry price can sometimes solve that problem through volume. But let's move on to the second category then, which I think you said was patent cliff and innovation stagnation.
Yeah. And so if you look at, I have a chart that I've used several times, which essentially just aggregated a bunch of the molecules that were discovered from the 1970s through the early 2020s. And it's just a downward trend in terms of discovery. I think there's only 30 some discovered meaning between herbicides, fungicides, insecticides, nematicides in the 2010s, something like 30 some relative to 90 some in the 80s and 70 some in the 90s. And so general downward trend. And the big driver here is Eroom's law in crop protection. And maybe to bring a little color to that, I think discovery has just gotten harder, and it's the low-hanging fruit's already been covered. There's only so much technology that you can lean into that you actually want to invest in because you're confident you're going to get a return. Because at the end of the day, lots of these companies are publicly traded. You can't just be willy-nilly throwing dollars here and there hoping to get an investment or hoping to get a return. You need to find the right fit, and there maybe hasn't been a ton of unique opportunities that made sense to invest in. And so I highlight Eroom's law, which is essentially the inverse of Moore's law, which was the doubling of transistors on microchips every 18 to 24 months. It actually was, call it, popularized in the pharmaceutical world, where instead of doubling of efficiency effectively every couple years, in the pharmaceutical world, you were seeing more time to bring a new medicine to market and more money. And that exact same trend is exactly what we see in crop protection. And so that's one of the things that I highlight. And I think a lot of that comes back to the low-hanging fruit was already kind of covered. We had a lot of the big discoveries, but the R&D investment, if you go look at FMC, you go look at Corteva, you go look at Bayer, you go look at New Farm, their R&D expenditure over the last decade has essentially flatlined or gone down. Corteva is maybe an interesting one. If you look at, they were going down, they're starting to tick back up because their CEO, Chuck Magro, has made that a mandate to increase their actual investment. But lower R&D expenditure doesn't necessarily deliver a lot of new molecules. And I think even the prioritization within that R&D expenditure has been reallocated in a lot of instances from not just from crop protection to, say, seed and trait, but from the actual molecule discovery towards more formulation technology, for example. And so that drives some of that decrease in new molecules as well.
So one of the things that when I was read this and other sort of articles that are looking at the same sort of dramatic erosion of R&D investment. Yeah, sometimes have a hard time sort of determining if perhaps a cause of it is simply, this is only a recent phenomenon, but the increased cost of capital makes those long-term bets even less attractive. And so you certainly have the quarterly capitalism impact on publicly traded companies. They need to be able to bring new products to market that have commercial promise, and they have a reduced appetite to be investing over 7-10-year horizons. Sometimes that's a generalized statement. So is it imagination suffering at the hands of shareholder capitalism, to put it in a sort of very general sense? Or is it actually that there's authentically not that much more innovation that can have at the molecular level? Have we reached the extent of science? Or is it somewhere in between? There's probably more options of creating a false binary construct here, but I'm surprised. I feel like if there was something promising there, surely they could sell the big bet on investing towards it. So any thoughts there?
No, I mean, so I don't know. I assume we're not at the limit, kind of to your latter point there. But I actually think the kind of big driver of it, Joe, it actually gets into the third force of where there are options and there is the ability to discover new molecules out there. But all of a sudden, over the last, call it 2, 3, 4 decades, the environmental scrutiny and the regulatory scrutiny has just gone through the roof. And so all of a sudden, molecules that maybe would have been viable in 1982 if you had discovered it, all of a sudden you discover that in 2026, and it's like, well, you know what, that does not meet any of the criteria. We're not going to be able to push that through in Europe or the US or Canada or Brazil or wherever, right? And so that's, I think, one of the big drivers there.
So kind of getting into the regulatory dynamics and regulatory divergence there. Might it also, and this is way outside of my area of expertise, but I think about the value added use cases for artificial intelligence and the advanced sort of AI-driven modeling that's available that can kind of leapfrog some of the biological constraints that exist within these sort of like long-term R&D cycles. Could we see the ability that you can sort of rapidly iterate and rapidly model, rapidly develop things sort of as a tabletop exercise, including some projections on what the environmental impact could be, what the human health impact could be, what the runoff implications could be? Is that potentially something that could reverse this? Or does it continue because some of these AI technologies bring the incremental cost of development to near zero over time once you've built out the infrastructure to handle it?
Yeah, I mean, the honest answer from where I sit is I don't know. But I mean, to bring a little color to some of that, though, Joe, I think is if you look at the Bayers and the Syngentas, they're kind of shouting out from the rooftops that, hey, AI can actually help with discovery. We can find new molecules, and I think there's probably some truth to that. I think kind of the thing to keep in mind when it comes to bringing new molecules to market, I think it's at like 12 or 13 plus years at this point, is that it's one thing to be able to discover the molecule, but then there's all the different, of course, you alluded to it, regulatory could potentially have some support from AI, but are regulators going to accept some of that stuff necessarily? Can you use AI to improve or speed up the field trial side of things and the talks? All those different things that kind of contribute to the cost and the timeline, I think, is still there. But fundamentally, I think if you go ask anybody at Bayer or Corteva FMC, I think they would all say they're pretty bullish on it and leveraging AI throughout the entirety of their workflows and R&D processes. I just don't know if it's going to, at least from where I sit, I don't know if you're going to see just a complete revision or reversion to, hey, we're now able to get this stuff out in 7 years and half the cost. I think if anything, it just becomes par for the course to hopefully keep things from getting more significantly expensive to bring molecules to market.
Sure.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
So technology could help, perhaps, and could clearly help innovative companies outrun the regulators in terms of speed, but they're not going to front run the regulators because that's still going to be the control point before something actually is hitting the fields at a commercial sort of scale and sort of any sort of officially cleared. So we've talked about expansion of the generics, and then now patent cliff and innovation stagnation was number 2. So since we're talking about regulators, let's go into the third one, which I think you said was the regulatory dynamics around crop protection products.
Yeah, and we just kind of talked about the first part where it's hard to get molecules approved in Europe and the US and Canada. You've lengthened registration cycles, and there's a delisting even of molecules, and there's backlogs to get products registered, and so it's still incredibly hard and probably going to continue to be challenging to bring, again, specifically to the synthetics. But even if you look at the EU, at least the last I looked, and things move fast here, but the EU hadn't necessarily changed their approach to registering and getting bio-based products approved relative to synthetics. And so you have some weird, again, regulatory dynamics that are there that drive things. You have the environmental pressure. There's a lot of scrutiny on that. Everything needs to make sure that it's not going to persist, hurt the birds and the bees, it persist in water, all those different things. But then even within that, you still have, and so that's kind of a societal sort of trend, right? That is driving things kind of where we're at. And I think that is structural. We're not going to go back to just bringing back molecules that have the, call it, environmental profile of chlorpyrifos, which is a really toxic pest insecticide. And so I just don't think that will change. And kind of within this same dynamic too, we also have just, and this is more North American based, of course, but you have the U.S. Trade Commission where they're looking at Syngenta and Corteva now on exclusionary loyalty programs that also start to change, like hamstring the crop protection companies and how they go to market. That's been something that's been incredibly successful. And if you look at what they're being accused of in the actual legal documents, it's kind of this, again, I don't know if it's true or not, but fundamentally they are essentially companies like Syngenta and Corteva are being accused of saying to a retailer, well, we'll give you the rebate of X if you do not let X number of liters or percentage of your total sales of this product segment go to a generic or go to this competitor. And so that, when the U.S. Federal Trade Commission's view, is anti-competitive. And so that also starts to contribute to some of the challenges and some of the things that have made these crop protection companies successful is their ability to bundle and package innovation together in a way that kept them with the most streamlined point of approach into the farm gate, so to speak.
Yeah, so a couple of things here I just want to call it out that I thought was interesting from the article and some subsequent reading I was doing on it is one of the contentions in the, excuse me, you probably hear the paper in the background, but as part of those exclusionary practices within bundling and loyalty programs you just talked about, I think it's saying directly that whether through coercion or just simply subtle sort of nudging, that the rebates are pushing distributors to legacy products versus the lower cost alternatives, which is going to prolong the market share beyond patent, defends pricing power, and it overall is just limiting access to generics, which ultimately is what's going to push higher prices through the channel and hurt the producer. And to what extent did this also, was this a pre-existing condition prior to the pandemic? Or do you think this also kind of caught fire in light of the significant cost increases from inputs and CP products that we saw as part of the supply chain disruptions you talked about earlier? I mean, farmers are making a lot of noise about it. The industry is making a lot of noise about the costs. So do you think this was already in the works?
Yeah, I mean, maybe I can't answer that directly. I don't have any knowledge necessarily, but I think if you look at these programs, they've been in place for years. This is kind of how the groups have operated. But to your point on the catalyst, it could have been that sort of dynamic. I think maybe to look at who was in place at the Federal Trade Commission, there was Lena Khan, who was very focused on managing and navigating anti-competitive things. And I think kind of to your point of there's the farmer dynamic here with the cost being increased to them if you start to lower access. But I'm sure that there was also some food price tie into that where,
Sure.
hey, you know what, this ties into a cost of food, which obviously was inflating a lot during COVID. So you could very well be right on that, Joe, but I don't have any inside knowledge of what definitely drove it.
But it was interesting because, as you said, this steady drumbeat of more things moving off patent and fewer new active molecules coming online has been in place for a long time. But then all of a sudden it hit this sort of inflection point where these became headline sort of cases. I think it's also fair that you highlighted there that it happened under the Lina Khan sort of regime in the Biden administration, but the current administration has demonstrated, or nothing to my knowledge, any interest in sort of winding that down or changing directions. And in fact, U.S. Agricultural Secretary Brooke Rollins has said they're actually going to expand scrutiny potentially to look at seed and fertilizers in case there's potential for antitrust violations within those supply chains as well. So I don't know if this is just good politics and it polls well, if there's reason to believe there's actually something happening within those supply chains. But the Justice Department also, I'm looking here, signed an MOU to, quote, scrutinize competitive conditions in the agricultural marketplace writ large. So it certainly seems that this regulatory divergence from the historical posture has some staying power across multiple administrations and multiple years.
Yeah, no, that's exactly it. I think I saw the same thing on Brooke Rollins' commentary, and I'm sure it's just something that it could be politics. I'm not sure, but I think fundamentally it is something that is. It seems like it's at least here to stay for the short term around that. And I think even when you start to look at some of the other dynamics within this, whether it's the Bayer being sued on the glyphosate front or the PFAS or the forever chemicals dynamic that Corteva is potentially at risk of. And so I think there's just a ton of things here that kind of that interplay of environment and regulatory and politics that really can further challenge some of the dynamics in the crop protection industry.
So I'm going to ask you to make a call here, and maybe we should create a poly market for this or something. But I think I believe it was within your work that Bayer is going to sunset or has sunset all the Bayer Plus rewards programs at the end of the 2025 marketing year. If Corteva, in their split into a separate CP and seed business, would be interesting to see would they actually relaunch True Choice and their sort of like loyalty program and some sort of a new thing. Do you think that if these bundling programs sort of come apart at the seams, these volume rebate structures, however you want to classify them, if they start to go away, does that really open the door then for mass explosion of generics to capture the remaining market share? Or do you think there's still some residual, call it loyalty, call it habit, call it perception of switching costs, that those branded products will still be durable at the farm gate with the American and Canadian producers?
I mean, there's probably multifaceted sort of thing here. And I think it's important to break apart farmer-facing programs and kind of retail or distribution-facing programs, of course, within that too. But I think fundamentally, if you look at you mentioned Bayer and some of the programming pullbacks and stuff, even how Bayer is going to start going to market with the likes of Precision Smart Corn and the system approach there, or what they've announced on the hybrid wheat side of things, if you're actually integrating holistic sort of agronomic system that's pieced together or pulled together by the likes of digital infrastructure like FieldView, all of a sudden the value of the farmer-facing program theoretically decreases a little bit in the incentive side of things there. So that's maybe one comment on that front. Then if you look at the retail side of things, I think 100% it would be interesting if they had to pull back entirely from, or mostly from, retail or distribution focused programs. Because if you go talk to a lot of the individuals at the manufacturer level, retailers might not acknowledge it, but these programs are a lot of the time positioned as a way of saving retailers and distributors from themselves, in the sense that they keep the price higher in the grand scheme of things, so that a retail's not just cutting everything down to the lowest price to sell to the farmer to win that outright. And so if that was to happen, that would be bad for the manufacturer, because they would start to get pressure on their margin. The retailer being unprofitable or distributor being unprofitable is not good. And so there would be a ton of dynamics that would change if you got rid of those entirely at the retail level, in terms of how and where profitability comes from. Because I don't know the exact percentage, but if you go talk to the average independent ag retailer, a lot of them on their crop protection business are not operating in the black until they get their rebate programs at the end of the year, right? And so when you start to look at that, I think it highlights the sort of dynamics of what that would do to the market. And
this is incredibly interesting. Let's get into the fourth one, which is probably a bit more abstract, but I think is probably the more foundational, or sort of, it's the big pivot that I think it's important, not just in what it articulates to the folks in our industry, but it also highlights a very different way of looking at sort of why people buy. And I think that's an interesting reframe of looking at the perception of value, the job to be done by a buyer, and what are they actually trying to accomplish when they purchase a CP program. So maybe talk to us the fourth one, which was complement disruption.
Yeah. So this, to your point, I think is abstract in a lot of ways because it hasn't really come to the market. Yeah, you look at, and I'll talk about the specifics of this in a second, but you look at See and Spray from John Deere in 2025 was on 5 million acres. So not a ton of actual installment base, so to speak, but this is one of the more interesting segments of the industry in my view from a crop protection perspective. And essentially the commoditization of crop protection products, in my view, is likely to accelerate as the new technology shifts, like what job, as you alluded to, farmers quote unquote hire herbicides to do. And so I look at this, I think, first through the jobs to be done framework, which was made famous by Clay Christensen. But farmers don't buy a herbicide to simply kill weeds. They hire it to achieve a weed-free field that enables high yields and operational efficiency. And historically, the herbicide differentiation has been defined by product attributes like efficacy, like crop safety, like price, like formulation, and more. And that's kind of where the driver of new molecules came from. You were differentiating on some combination of those things. And this allowed manufacturers like Corteva and Syngenta to sustain premiums through that intellectual property and incremental product advantages. But that dynamic shifts when precision spraying technology changes where differentiation occurs. And when the sprayer, meaning a John Deere See and Spray or a Green Eye product, for example, when the sprayer, it's historically been a complement to the herbicide. But when you start to make it smart and have that technology loaded onto it, like the See and Spray, it starts to shift the locus of where value creation and value capture occur. And so a system that can identify weeds and selectively spray with multiple tanks alters the farmer's calculus. So the value of tank mixability goes down, residual changes, even relative efficacy could change theoretically, right? And so instead, the performance is driven by a farmer's precision sprayer's precision and data feedback loop. And so this is what Ron Adner, who's someone that I have read a bunch of his work, very interesting, one of the best strategists when it comes to management theory. And so he talks about this as disruption through confluence, where the power moves from the producer of the core offer, which would be the herbicide in this instance, to the complement, which is the sprayer. And so this is where that disruption through complements can occur in two different ways. And the first is by commoditizing the core products and eroding its influence. And second, by reducing overall usage of the core product, so total volumes. And in theory, precision spraying would do both. And it makes herbicide products more interchangeable and simultaneously reduces the volume or total volume sprayed. Although I have a slightly different view of Jevons paradox, potentially changing that over time, but fundamentally in the short term, it can change the total volumes. And so that almost creates a negative flywheel as well for input manufacturers, where the positioning from precision spraying companies and the farmers who adopt them become the primary beneficiaries relative to the crop protection company themselves. And so I think this is where you could see generics gain ground, or ag retails with a fleet of precision sprayers begin to rethink their supplier relationship, their service offering, and kind of how they rely on the traditional crop protection manufacturer. So I'll stop on that there. But this to me is where I think is really compelling and interesting, and one of the things that I think everybody in the crop protection, whether you're a retail, farmer, equipment person, like it would be fantastic to understand this concept, just to see it as it plays out.
Yeah. So thank you. That I love the passion, Shane. It's infectious. I'm going to take it back to the beginning. So to the jobs to be done framework that you talked about from Clay Christensen. And so you talked about, I think the example you gave was farmers don't buy an herbicide to kill weeds. They hire it to give them a weed-free field for all the benefits that accrue thereof. So the classic example, when I first heard about it, was some guy in Home Depot on a Saturday isn't shopping for a hammer. He's trying to get a hole in the wall where a nail will be so that the family picture can hang prominently where he wants it to hang, right? So it may not change how you retail a hammer, but understanding what the person wants, what they're trying to do, what the job is they're trying to accomplish, is a way to sort of stress test and reverse engineer the kind of product that you're offering and what differentiates. And so in the context of a weed-free field, you sort of look and say, okay, perhaps the commoditized products dominated by generics, some sort of custom blends and custom formulations, but largely a static set of different options there. The commoditized herbicide with a standard range of efficacy is no longer the main differentiation point. It becomes the technology that enables the precision application of that. And I think that's a really interesting thing. And frankly, a shout out to all the listeners, something to think about doing across your business. Think of one of the products or services that you currently provide. And for a fun exercise, open up Claude or ChatGPT or whatever LLM. In a very simple prompt, you can say, using Clay Christensen's Jobs to be Done framework, help me rethink, why is a farmer buying this particular type of seed? Why is this producer buying this particular product? Why do they sell us their grain? And it will really challenge the transactional nature by which we look at these sort of things. And it'll change where you look at where does differentiation allow value to be created and ultimately value to accrue within your business. And I think that's why this complement disruption is obviously it's very closely tied to the four forces. It's one of the four forces, but it has broader application. And I wanted to highlight that for the benefit of industry because it's a very interesting construct that I think is underrepresented in agribusiness.
Yeah. It's a very powerful framework in my view. And I do that same thing, trying to look and break things down as you alluded to. And I think I do want to make sure I state this properly too, because I don't know if I did a great job when I initially went through, but fundamentally, if you think about, if you're an agronomist and you're making a recommendation to a farmer for alleviating water hemp in a field, you're first looking for a product that has efficacy on that specific weed, but then you're looking, okay, well, what other weeds do I have in the field? What am I going to have to tank mix it with? Well, what crop stage is it okay to be applied? What's the residual this year? Is it going to give me any residual to control the weeds? Is it going to have a restriction on what I can actually grow or plant next year? And so in the world we currently operate with a broadcast sprayer, you're having to think about all those. And that's where these new products, new molecules from Bayer, Corteva, FMC, whoever, they have benefits from that. They might be more crop safe. They might have a wider label for application. They might have lower residual, or they might have lower total rate needing to be used, for example. So all that benefits, it gets taken into account to make a herbicide decision. But when all of a sudden the sprayer has the cameras on it, it can apply only at one nozzle or two nozzles based on wherever the weed is, all of a sudden you might not be hitting that crop anymore. And so crop safety is not as big of a consideration. You also don't have the same dynamics from a residual perspective, because you might not be saying, okay, well, I don't need to worry about any sort of residual for weeds with this, so I'm going to actually make a different herbicide decision in a pre-plant application so that I have a residual already. And so all of a sudden the considerations for picking a specific herbicide, they don't go out the window, but they change. And that change typically is going to be towards, I have bromoxynol or I have 2,4-D, cheap off-patent products. You can use those at higher rates and still get the same sort of efficacy, not have to worry about the crop safety. And now the need to use some new molecule that has all these new sweet features that could be crop safe, easier tank mixability, all those sorts of things. You're just not looking at it the same because you also have a multi-tank system on your sprayer. And so that's really where you start to see the commoditization risk is, well, why not just have a bunch of 2,4-D and whatever? Again, I'm oversimplifying. There's going to be different dynamics within this, but that's where you start to look at, if I'm a retailer, I might say, well, you know what? I don't need to necessarily bring in all these new molecules or new products. I'm going to create a weed-free field. I'm going to have these relationships with this generic manufacturer and bring these products in at a very low-cost basis to me and offer the whatever weed-free field to the farmer based on that service per acre, not the service of applying the product plus the price of the product, only an integrated bundled service offering where it is just, hey, we have seen spray on our system. We actually are going to go across the field and make sure that you don't have any weeds. And that costs, I'm making up, $20 an acre, whereas they might have spent $15 before the farmer. The retailer might have made lower margin. They could also increase it. Again, it just fundamentally shifts how you can start to think about it from a service offering for a retailer, but that also changes, of course, the competitive dynamics for the crop protection company. And again, there's obviously more products than fungicides, but you start to look at than herbicides, there's fungicides and insecticides. But if you start to look at some of the other dynamics like interplant technology, which again still weighs out in terms of having that clear across the field, but that's where they have a relationship with John Deere, which then all of a sudden you could say, oh, well, we know exactly where the disease is in the field. We fundamentally change where we spray, where we apply, those sorts of things. So there's a ton of interesting implications potentially here.
For sure. Well, a call to action for our listeners, and particularly those that are either independent ag retailers or more likely co-ops that are really serving as the connective tissue between some of the big product distributors, or the manufacturers themselves, and the grower. These are really important things to think about. And so I'd encourage you to go back and listen through, think of what are the implications for your own operation today, how it may enable and accelerate some of the things you've been trying to do strategically, where it may actually throw wrenches. Increased expansion of generics and availability of generics coinciding with less active molecules coming on, the increased regulatory scrutiny and some of the challenges to the manufacturer level programs and what the downstream impacts of that could be. What Shane just talked through here around complement disruption, I think none of them may present a competitive threat today, but all of them are going to have implications for the business tomorrow. And so beyond the obvious plug to subscribe to Upstream Ag and check out Shane's work every week, at minimum, I think really stress test your business back against some of these changes, even if you don't necessarily agree, even if you don't necessarily think that this is where things are going. A fair dose of scenario planning, it costs you nothing but the time it takes to do it, to say, okay, well, what if we're wrong? What if it is true? What would that mean for us, both to the upside and the downside, and kind of work through that. Shane, you've been on the show a couple of times now. I appreciate you as always, the work you do, but also your willingness to come on the show periodically and kind of dig deep in a different medium to kind of explore these ideas. It makes for a more effective, robust, and resilient ag supply chain and agribusiness sector. And so I just thank you for doing what you do.
Yeah. So thanks for having me, and thanks for having me on. I can't thank you enough for that. I'm an avid listener of the podcast, and so it's awesome to be able to join you and have a conversation.
Yeah, well, we look forward to the next time. And to our listeners, I appreciate you as always being a part of the Pacesetter Pod community, taking the time to listen to some maybe non-obvious or non-consensus perspectives, to consider what it might mean for your business, and then ultimately to consider actioning different ways to improve strategy execution, all in support of growing your agribusiness, which is why we do this show every week. Thanks for joining, and I look forward to having you next time right here on the Pacesetter Pod.
This is thepodcastfactory.com.